Good morning, this is Ken Long at Tortoise Capital with a review of the weekend trading report for May 5th, 2018. Market is in sideways normal conditions. On an annual basis, using NDX 20, we are in the middle of neutral at 60 out of 100 on a 10-day basis. We are just below overbought at 78 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is in sideways red at 1.77%. The slope of the 50 is red bearish at minus 0.27. Intermediate strength of trend using ADX 14 is neutral at 23.5. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. Current reading is at 1.137, so we are in risk on conditions favoring the long side and riskier assets. Take that score and look at the last 5,000 trading days and find the average and standard deviation in order to compute the risk Z, which is at 1.43. Here you see a 90-day histogram of that indicator. So we're 1.43 standard deviations above the long-term normal in terms of the risk Z. Again, favorable for the long side, but the declining scores suggest to be on our watch, as going from below -1 to above 1.0 is the sweet spot for swing trades on the long side. This declining risk Z suggests getting a little long in the tooth and vulnerable to downside. You combine that with sideways normal, and the swing side is vulnerable to sharp corrections. These are the current holdings for May for the blended month rebalancing. The next reevaluation on or about 1 June. Theoretical exposure in ETF2 is a low 20%. Quick look at some blended monthly rebalancing portfolios. I'm looking for relative strength winners that had either follow through or weakness. Technology is strong. EWA is an example of something that was weak that has put in a nice little turnaround here, so that's reflecting some strength in commodities in the short term. EDF 32, again, is technology doing well. And then weakness, consumer staples, reds across the board, along with Brazil and Latin America. In the Dow 30, Apple, responsible for a lot of the gains in tech this past week. Cisco and Intel. Yeah. Let me just go back and take a look at GE. GE continues its nice little run after a big rebound over the last 6-month sell-off and 3-month sell-off. It's already starting to turn the corner against some of the other longer-term losers like 3M, Procter, Dow, Walmart. Sector spiders, oil and gas, software, innovative technology and healthcare, weakness in farms and staples. ETF Max, this looks at over 500 ETFs and finds the real winners and losers. Oil looks to be interesting here, consistent across the board. Take a look. Yeah, oil once again. Small cap oil, energy. Wow, I have to look at that one. Market health check. The vertical blue lines are 10, 20, and 30 days worth of look back, 40, 50, and 60. Horizontal red lines are support levels that have held and are price targets on the way down. Purple lines are price targets on the way up. Previous swing high, locking in here at about 285. Accidentally trimmed that price. can see prices holding at about 7% off that swing high, so still weakness. I'm noticing 3 lower lows in the dragon and the baby dragon, which has kind of put a cap on this last 10 days. Prices in the top half of the dragon, but and the river, excuse me, but the river sloping downward. The PSAR is still pointing towards down. Now, if this were to hold here, what we would have is essentially would look like a double bottom in this support level, and so it really has to get through about 278 here and root back to the swing high. So we're getting a range compression too. You notice the compression of the Bollinger Bands, the rising 200-day moving average acting as support. MACD histogram, the last signal is down, so we're below the 0 line, so this is still negative, but we are back to the 5-period smooth. So this is really typical of sideways normal coming to a decision point here. Is the 200 going to act as support, or is this all going to crack? So a test of the 200 really is what I see in the week ahead. Almost everything in ETF2 on a cash signal, less technology and small caps. Mixed bag among the sector spiders. Real weakness in energy and healthcare, although as we've seen, energy has put in a nice 1-week recovery. Strength in materials, industrials, and utilities. Mixed bag in the U.S. And in Asia. Yeah, this is just typical of a sideways market that's trying to find the new and emerging leadership. So we'll play it shorter term rather than committing to swings or longer term position trades. Retail has had a nice little bounce, green and white. So I look for that along with the growth index, green and white, and sovereign debt, green and white. These are all signs where they were above average on consistency and then have become excellent this week, so that looks good. Those look like symbols for emerging strength. ETF liquidity based on the 30 days of average volume and multiply that by price to get the average daily dollar volume, and then ATR percentage is looking at their volatility and therefore shorter term tradability. So things like the VIX, oil and gas, semis are all excellent trading candidates because they combine both liquidity and volatility. Looking at the daily report, no signals in channeling an overreaction. Disregard this, sir. I've updated that on the in the weekly. That'll be reflected correctly on Monday's report. So remember, we're still in the middle of neutral. Had to change a formula. 10-day max pains, Caterpillar, AT&T, 3M, Goldman. Lots of auto framers testing out well with some 551Ws based on good price action on Friday. Looking for some potential momentum there. Disney, McDonald's, and Apple. Apple broke out to all the way from a 10-day to a 12-month high. That's what the index is showing us. And Verizon too. So both of those would be on my short list for performance follow through on Monday. Just a channeling here in VIX. Some good auto framer numbers. Mexico, Latin America, and Brazil, the whole Latin America complex, all with like a 2-day washout in the RSI2. Been suffering on the 10-day and 1 month especially. Mexico, notice it broke down below its 10-day and 1 month trading range. Makes that an interesting candidate for the short term in both directions. Oil had an exceptional day. And then breakouts in technology and real estate. The daily pinch and stretch. Devon Energy, not surprising, strength in energy here recently. Most positive Z stretch, that's above its 30-day Bollinger Band mean. That's the specific percentage. That's how many standard deviations it is. And then the negative stretches, not surprising again. Mexico and 3M. Now 3M, this is actually an improvement. It was 10%, it's now 5%. Only Disney on a super pinch right now, so we'll go take a look and frame that one out for the swing course. Auto framers, and for the those who are swing trading one day at a time, using the mechanical entries to establish your trade frames, and the reward to risk ratio based on a test of the 10-day high. Regression line fractals, the top shelf, these are the deep value plays. So 3M is a little over 8 ATRs below its long-term fair value. So here's just a quick example of Mexico, the Z3 breakout, SQC breakout here, and MACD histogram crosses a zero line. So we get the mechanical entry above yesterday's high, right in here. Hold that till it comes to a support level, resistance level, excuse me. The move is over when MACD histogram, or the MACD signal line, crosses exponential outside of the Z2. That's a good price to preserve. Stop and reverse with a target back to the RL270, which has been sloping downward. Collapsing dragon, second position here. Collapse, the RL10 collapse. So second position short here. And holding nicely, we would place our stop down here by the 2. Or the one-day high, excuse me. And that's because we've got the MACD outside of Z2. So that's a really nice run. Sort of has the yin and the yang, and so this is an extreme move that we want to make sure we lock in the gains on. This was that rebound in 3M. Started talking about it was that's when it was 10% below its, or a 10 ATR below its RL270, and you can see the rebound has occurred already. So we got like a 1, 2, 3 re-entry here. First target, second target, third target, and we got the crossover outside the Z2. So if we had been short in here, this would be the indicated exit, is when it makes that mechanical entry, when it gets 5 cents higher than the previous day. That's a good place to cash that short, and a good place to initiate a long, because you have a low risk entry and reasonable price targets on the way up. Okay, back to the report. So that's what 3M looks like. General Electric is 4.5 ATRs above its RL270, so let's just see what one of those looks like. Again, so you can see the 270 here. Let me, yeah. So that's still 5 ATRs above. So this was that rebound off the bottom, but already this is starting to show weakness. The PSAR collapse occurred back in here. So really the play is on weakness below the mechanical bottom of yesterday, which is really a break of the Bollinger Band mean. Your target would be back down here at the RL10, and essentially where the PSAR flipped. So right in about here. 1297 is the downside target if it fails. Upside target, it's got to get through about 15, let's call it 1497 or 1510, where the PSAR stop for the short would be. So that's sort of the profit target on the way up. I would have no qualms about taking this one along at about 1420 with a target 1 here. If it gets above the Z2, that's what you have to be at no lose plus dinner for 2 by that time. That would be enough, I think, to make the PSAR flip. So that's the two different kinds of RLFF trades you get, the ones that are above their 270. And this is characteristic of one where the 270 has been declining, but a bottom has been put in and some near-term buying pressure. It takes a long time for that 270 to switch. So this is going to be some chop, but you can see we can frame trades in both directions. If these fail, then whatever was causing this to fail is really true, and so we're back in line with the primary strength of trend. I mean, so the trend is down, obviously, but when you get this PSAR, if this doesn't follow through, this was the measured move we made on the previous one, but a nice long period of 2 weeks worth of support. First buying surge, it's been holding up pretty well. So we have a target back up into here, and certainly there. So you can be playing this like in the yellow zone with a short towards here or a long towards here. Okay, back to the report. No squeezes. 30-day regression channel still chopping around. We're right back at the long-term average, just about right in here. We've come back to normal after a flirt with a double bottom. And again, this is the place where, high, lower high, lower high. If this collapses, then it's back down to here. And this is where it violates the 200-day moving average at that dashed line. So this is a chance for this market to collapse further. Z-scores of the three regression lines. The 10 is in the bottom half and all the way back up to the 0 line. The 30 has made its double and is rolling over. The 90 is now below the river. So this Trump bump that we've had has been all negated now by all of this negative price action, which started right about in here. So this is now like the moral or the price equivalent of that runaway move to the upside. We now have a negative in the 90. But again, bottom of the river may be holding support. And if that collapses, then it's here, and then it's Katie barred the door down to 245. Just flash through these charts for reference for those of you keeping score at home for the intraday trade framing. And that's everything I wanted to cover. Keep your risk measured and your powder dry.